Welcome to the CFA Level 1 presentation on financial reporting quality, red flags and accounting warning signs. So the first point we'll discuss is on why a company might manage earnings. So managing earnings is much worse than it sounds. This basically is a euphemism for times when management is trying to basically manipulate financial statements to either increase their projected or reported net earnings or to decrease or understate their reported net earnings. Now, why might a firm want to possibly overstate net income? One reason might be to meet earnings expectations. As you know, in the financial world, analysts are carefully monitoring what the earnings per share for a company will be, and typically there is this concept of consensus earnings per shares, and then let's say for a given company the consensus earnings per share equals $2.50. Now there is a huge incentive for firms to try and meet this expectation, because when earnings fall, if the reported earnings number falls a little below this, the stock price is going to take a huge hit. So that's one possible reason. Another is to remain in compliance with lending contracts. So for example, you might have lending contracts where there is a requirement that the coverage ratio, which is your operating income divided by interest, must remain greater than 5. So if for a given company this ratio is falling just below 5, there might be an incentive to try and manipulate the operating income so the reported number is a little higher than what it should be, and that allows the company to remain in compliance. And another reason might be to try and maximize incentive compensation. If management compensation is tied to earnings numbers, then that's where this might be a reason. Firms might also want to understate net income, and this would be to obtain trade relief, so either get subsidies from the government or tax breaks or some other benefit from the authorities. The other reason is to possibly negotiate favorable terms with suppliers, where a company might show its low earnings and use that as a basis for negotiating lower prices in the contracts. Next, we'll talk about low quality earnings. So what does this mean? First of all, let's just understand the basic concept of low quality earnings, and then we will talk about these points. The basic idea is this: low quality earnings, first of all, does not mean low earnings. It means that most of the earnings being reported are coming because of the accrual process. So let's take two companies, A and B. So let's say both report a net income of 100. So let us take a situation where two companies have reported earnings of 100, company A 100 and company B has reported earnings of 100. And let's say that for company A, out of this 100, 20 is coming based on cash, and the remaining 80 is based on accrual. So this 80 is based on receivables which will be collected later, versus company B, where 90 is coming directly in cash and only 10 is coming in the form of accounts receivable. So in this case, we will say that company B has high quality earnings because most of the earnings are backed by cash, whereas company A has low quality earnings because most of this earnings figure is based on accrual accounting, where we have recognized revenue and hence net income but not actually received the cash. Okay, so now let's get into the details. Companies accounting rules can be exploited to achieve a specific outcome. And this essentially means sometimes companies can maybe be overly aggressive about revenue recognition while remaining within the rules, but maybe being more aggressive than a company should be. And if that's about revenue recognition, that would result in higher revenues and higher income, but not necessarily in higher cash. Activities that will result in low earnings are selecting acceptable accounting principles that misrepresent the economies of a transaction, structuring transactions to achieve a desired outcome. So for example, if a company wants to show a given lease as a operating lease, then it might just structure the lease, even though let's say this lease should be shown as a finance lease, but the company structures it so it just about meets the accounting requirements of an operating lease. Another is to use aggressive or unrealistic estimates and assumptions. So for example, if a given machine should be depreciated over 6 years, but instead the company depreciates over 7 years. So this will slightly understate the depreciation expense, which will overstate the earnings. Exploiting the intent of accounting principle. We don't really need to get into the details of this, but the basic idea here is that staying within the framework of accounting rules, so companies might follow the letter of the rules but might not follow the spirit being that the numbers being presented should reflect economic reality. Now next we need to understand this concept of a fraud triangle. 3 conditions that are usually present when fraud occurs are: number 1, there is the incentive or pressure to commit some sort of fraud, and generally this means that some motive exists to commit fraud. Number 2, the opportunity exists, and this typically happens when there is weakness in the controls mechanism. And third, there is some attitude or rationalization that some sort of fraud activity is okay, and essentially a mindset that fraudulent behavior is justified. When all these 3 occur together, that's called the fraud triangle. Now let's talk about each of those items in the fraud triangle in a little more detail. Number 1 was the incentives or pressures, or this was the motive reason. Threats to financial stability or profitability. So if this condition occurs, that creates a motive to commit fraud. If there is excessive third-party pressure on management, this might come from maybe analysts expecting a certain earnings per share, so that puts immense pressure on management to meet certain numbers. Personal net worth of management or directors is threatened. So if the net worth or the compensation of management is based on stock price, which in turn is based on reported earnings numbers, that can provide a motive for overstating earnings. Excessive pressure on management and employees to meet internal financial goals. So the owners of a company put immense pressure on the senior management to meet certain cash flow or certain cash flow requirements. So all these can create a motive for fraud. Next is opportunity. So the type of industry in which we are operating might create opportunities, especially industries where there are lots of related party transactions. So if you take an industry where under the same, let's say under one holding company, there are several businesses that buy and sell from each other. So this potentially makes it easier to create transactions that in turn either inflate revenue or understate expenses and so on. Ineffective monitoring of management. So if the board of directors if the board is weak, that allows management to get away with fraudulent behavior. If we have complex or unstable organization structure, which basically means that it's difficult to determine who is in charge. What this will often result in is, if something fraudulent happens, if you can't clearly pinpoint who is responsible, you can't then fire that person or that the set of people involved. So anytime you have a complex structure where it's hard to identify the culprits, then there'll be finger pointing and an opportunity to commit fraud. And then finally, inefficient internal controls. So all these items, or all these are potential situations that create opportunity for fraud. And number 3 is attitudes and rationalizations. So one is if we have poor ethical standards. Secondly, if there are acceptable ethical standards, but there is ineffective communication and the support and enforcement of these ethical standards is weak, so these can result in a rationalization of fraudulent behavior. If there is excessive participation of non-financial management in the selection of accounting standards, this can create issues. History of violations, inappropriately minimizing earnings to reduce taxes, failure to correct known errors in a timely manner. So all these are areas or items that might result in a rationalization of fraudulent behavior. Now, some common warning signs. Let's just take a step back here. One of the most common forms of manipulating financial statements is where companies are overly aggressive about recognizing revenue. And this is a quick link with the reading on income statement, where we talked about revenue recognition criteria. And companies might be overly liberal in interpreting those criteria that we talked about in the income statement reading. Some things that companies can do, one is called bill and hold, where the company bills the customer and hence books revenue but holds the merchandise. This actually is a clear violation of one of the revenue recognition standards, because a company should not be able to book revenue until it has delivered goods to the customer or shipped them, and basically the risk of the goods has been transferred to the customer. Another way is sales type leases. So as you saw in the earlier reading on leases, if a company is recording a sales type lease, that results in revenue going up. So if a lease should have been an operating lease but instead is recorded by the lessor as a sales type lease, then that would result in revenue being overstated and hence potentially net income being overstated. Recording revenue before earnings activities are complete. So this would again be a violation of one of the revenue recognition standards. Basically, we need to make sure that when we record revenue or realize revenue, all the goods have been delivered, all the contractual terms have been met. Only then should a company recognize revenue. And using swaps and barter trades to boost revenue, again, this was discussed in the reading on income statements. Some more warning signs. If there is a divergence of the cash flow from operations and earnings, that's a warning sign. So over time, if a company's net income is going like this, and let me just restate this. So over time, if the net income is going up, but the CFO is trending downwards, then this divergence is clearly a warning sign. What this is implying is that the company is somehow recognizing income by maybe aggressive revenue recognition or understating expenses, whereas the cash flow from operations coming in is very low. So eventually what the net income is likely to come down drastically in such a situation. So positive earnings, negative cash flows as shown over here, that's an issue. the ratio of cash flow from operations divided by net income, if that's 1, less than 1 or declining, that again is an issue as depicted by this simple graphic. If we have abnormal sales growth relative to peers, then that might be a warning sign. An analyst should clearly see why this is happening, and the sales growth, if it is happening, should be explained by some logical economic reason, such as if the company literally has a competitive edge over the peers, then this might make sense. Otherwise, there might be some accounting irregularities. So abnormal inventory growth relative to sales growth. So there are two possible issues here. One is that the company is building lots of inventory, which would possibly be becoming obsolete. So that's a sign of write-offs and losses later. Another issue might be that the company is potentially using old inventory or old costs as in the cost allocation process. The inventory that was acquired earlier at low prices is the one that is being sold, and the inventory that remains on the balance sheet is the high value inventory. So what this strategy does is that it boosts the operating income, but that's only a temporary boost. Next is boosting revenue with non-recurring gains. Again, as the term implies, an analyst should be very careful about these non-recurring gains, and in his or her analysis, these non-recurring gains need to be adjusted for. Delaying expense recognition. This would make net income seem higher in the short run, but obviously in the long run income will come down. A company might hide expenses by classifying them as extraordinary. This would make the income from continuing operations seem high. And finally, actually this is a repeat. We've already talked about delayed expense recognition. More warning signs: abnormal use of operating leases by lessees. So this tends to overstate many. Abnormal use of operating leases by lessees. This tends to overstate many ratios. LIFO liquidation. This is where a firm is using old inventory at low prices as their cost of goods sold, which boosts their profitability numbers. Abnormal gross margin and operating margin. This again might suggest, this is a warning sign, so an analyst needs to see why is a company realizing abnormally high gross margin and profit margins. So there needs to be a good reason for this. Extending useful lives. If companies extend the useful lives of their assets, that means they are reducing their depreciation and hence increasing their operating income. So if this is happening, there needs to be a good reason. Aggressive pension assumptions. These aggressive pension assumptions tend to reduce pension expense and the pension liability. So an analyst needs to determine whether these pension assumptions are justified or not. If the pension assumptions are overly aggressive, then that implies that a company is trying to manipulate financial numbers. If a company keeps producing year-end surprises, that is also a warning sign. Equity method investments and off-balance sheet special purpose entities. This is a little advanced for level 1, but I'd say at this point you just memorize that the equity method for investments tends to overstate or tends to make financial statements look better than they are. So if a company is using excessive use of the equity method, that might be a problem. Don't worry at this stage if you don't quite understand what the equity method means. We'll see this in detail in level 2. Off-balance sheet financing agreements, including debt guarantees. So if a company has lots of off-balance sheet agreements, such as operating leases, or banks which are giving their customers various guarantees, that can be a potential problem. So when banks give guarantees to their customers, those that is called contingent liabilities, which don't show up explicitly in the balance sheet, but they are stated in the footnotes and need to be looked at very carefully by an analyst. So that's it for this reading. As I keep saying, you need to practice, so do all the problems from the curriculum and your study notes. If you have any comments or feedback on this video lecture, please share. This will allow me to improve future lectures, and if you like the video, please say so. Thank you.